Hello everyone, Tyler Lavoie here, financial planner. Today, we're talking about one of the biggest blind spots in retirement planning, and one of the most avoidable too, how taxes actually work once you stop working. And so here's something that I hear consistently from people I meet with. I figured my taxes will go down in retirement, and I understand why. You're not working, your income should be lower, but for a lot of families, that's not what ends up happening. And the gap between what they expect and what they actually owe, that gap has real consequences for how long their money lasts. So let's actually have a conversation about what is going on. And so there are three things that make retirement taxes different from working years. First is, for the first time in your life, you actually have control over when you decide to take income. That's actually a huge opportunity, but only if you plan for it. Secondly is you have multiple income sources that tend to hit your tax return at the same time and in ways that aren't intuitive. Social Security, investment withdrawals, maybe a pension, these end up stacking. And third, after age 73, the IRS removes some of that control through something called RMDs, or required minimum distributions. So you end up taking the money whether you need it or not. And that's one of the surprises that people most oftenly get. And so let's start with the tax bracket structure. A common misconception for people is they believe that they pay based on the tax rate on everything. But it doesn't end up working that way. You pay each rate only on the income that falls within that overall range. Think of these as pour over buckets. So if you're looking at someone in the 10% bracket, $0 to $24,800 is taxed at 10%. Once you're a dollar over that, that's when that $1 is then taxed at 12%, and so on and so forth. And so not all retirement income is taxed the same way. And this is why planning makes a real difference. Withdrawals from traditional IRAs and 401ks, RMDs, and pension income, these all come out as ordinary income and are taxed at whatever bracket you end up in. But long-term capital gains from investments get preferential rates. So these end up getting 0, 15, or even 20%, really depending on your income. And Roth IRA withdrawals in retirement are completely tax-free. So understanding which accounts produce which type of income is the foundation of tax-efficient retirement planning. And so how does Social Security get taxed? Because Social Security taxation is one of the most misunderstood pieces of the puzzle here. And whether any of your benefit is taxable really depends on something called your provisional income, which is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. So for most retirees, once you add up Social Security, your portfolio withdrawals, and other income sources, you're above the overall $44,000 threshold for married couples, which means up to 85% of your Social Security can be taxable. And here's what catches people off guard. A $10,000 IRA withdrawal doesn't just add $10,000 of taxable income. It can also trigger another $8,500 of Social Security to become taxable. So the real cost of that withdrawal may be significantly higher than it appears on the face of that. And so when describing and discussing RMDs, these happen at age 73, where the IRS requires you to start taking withdrawals from every tax-deferred account that you own, your traditional IRA, your 401k, and others. The calculation, in order for them to calculate it, you take your December 31st account balance and divide it by an IRS life expectancy factor. At 73, that's roughly about 26.5. So a $500,000 IRA generates a required withdrawal of about $18,868 taxed as ordinary income, whether you need the money or not. And as your balance grows and the factor shrinks over time, those RMDs amounts increase. If you end up missing a distribution here, the penalty is 25% of the amount that you were supposed to take. And this applies to each account individually. And so here's a scenario that most common: a couple with a modest pension of $18,000, Social Security of 24 grand, and an RMD of 28 grand already has $70,000 of income before they've even taken a single discretionary withdrawal. And the point of this is not to be catastrophic, it's that it's predictable. And predictable means that it can be plannable for you. And so the Morningstar data puts a number on what taxes actually cost over time. So from 1926 to 2025, the stocks returned an average of 10.5% per year before taxes and 8.5% after taxes. So that's a 2% gap compounded over decades. And this represents a significant reduction in wealth. And on the tax deferral side, a $10,000 investment held for 35 years in a tax deferred account provides roughly 14 grand more than the same investment on a taxable account. So these numbers are why this conversation matters. It's not because taxes are the enemy, but understanding them is how you keep more of what you've worked so hard to build. And so here's the practical implication. The years between early retirement, when RMDs begin at 73, are often the lowest income years of your later life. Before Social Security is fully in play, before RMDs stack income onto your retirement, this is your window. The strategies we'll cover in the next two videos, Roth conversions and withdrawal sequencing, these work best when you act during the window, not after when the window closes. So the four things I want you to remember is: 1, retirement income is taxed, but how much depends on an account type and timing. 2, Social Security can become partially taxable based on your income and other income. 3, RMDs at 73 create forced income that you didn't ask for. And 4, the years before 73 are your most important planning window years. So in the next video, we're going to go deeper on the Roth conversion strategy most people in their late 50s and early 60s aren't thinking about yet. And if you'd like to talk through of what any of this means for your specific situation, how taxes could affect your retirement picture, I would invite you to book a complimentary retirement readiness chat. There's no pitch. The conversation roughly lasts between 15 to 30 minutes, but it's to help provide you a little bit more clarity. My name's Tyler Lavoie. Thanks for watching, and I'll see you in the next video.